Welcome back to the Deep Dive, the only place where we take stacks of complicated financial history, market turmoil, and trillion-dollar institutions and cut right to the most fascinating, essential knowledge you need to be well-informed.
Today, we are attempting to map the entire life cycle of a true financial behemoth, Citigroup, or Citi as most people know it.
And this isn't just another bank.
No, not at all. It's a force multiplier in global finance. It's one of the big four U.S. banks. It's a core bulge bracket investment bank. And maybe most importantly, it's designated by global regulators as systemically important.
Which is, that's just the textbook definition of too big to fail.
Exactly.
And when you look at the sources, the scale is it's dizzying.
Yep.
As of 2024, we're talking about an institution with, $2.353 trillion in assets?
Trillion, yeah. And a global workforce of around 229,000 employees. So like you said, this isn't just a bank. It's this massive, interconnected, cross-border financial machine.
And when it shakes, the whole world pays attention.
Our mission today is to really unpack this huge 200-plus year history. We're going to try to trace its earliest origins as a disruptive global innovator.
Then get into that dramatic, defining 1998 mega merger that basically defied regulators.
Right. And then, of course, its central catastrophic role in the 2008 financial crisis, a crisis that required, historic government intervention and a $306 billion guarantee.
And we have to finish with what's happening right now, this continuous, massive strategic restructuring under its current leadership, including a dramatic overhaul of its technology. All while, tracking this constant, expensive thread of regulatory scrutiny that seems to just perpetually haunt its operations.
It's a story of pioneering vision that meets, spectacular failure, followed by a long, painful decade of trying to shrink back down to a manageable size.
Okay, so let's start unpacking this journey. The modern company, as we know it today, was essentially born in 1998, right?
That's the moment. It was the merger of two giants, Citicorp, which was the bank holding company for the retail giant Citibank, and then Travelers Group, the insurance and brokerage conglomerate.
Though the Travelers insurance part, that didn't stick around for long.
No, it was spun off just a few years later in 2002. But that merger moment, that's what truly defined the modern firm structure and, frankly, its appetite for risk.
And for you, the listener, to sort of grasp how Citi operates today, it's worth noting its two primary arms.
You've got the Institutional Clients Group, or ICG.
That's the high-level corporate and investment banking arm, the classic Wall Street component that deals with, massive treasury services and securities for big corporations and even governments.
And then on the other side, the consumer side, you have personal banking and wealth management, or PBWM.
And this division includes the Citibank that everyone sees on the street corner.
Right, the ubiquitous retail bank.
Yeah.
But it's also, and this might surprise you, the third largest issuer of credit cards in the United States. So whether you're a global Fortune 500 company or just, paying off your monthly credit card bill, you're interacting with Citigroup.
Let's start at the very, very beginning, tracing the roots of what became Citicorp. This story kicks off in the early days of American finance.
It does. The initial charter was for the Citibank of New York, granted on June 16, 1812, right here in New York.
1812, that's incredible.
It launched with $2 million in capital, which was a huge sum back then. It was specifically created to serve a group of powerful New York merchants and traders who were navigating that very new American market.
The early history seems to be a masterclass in adaptation, survival, and really seizing leadership during all that market chaos.
Absolutely. If you look at the early leadership figures, they were a huge part of driving that expansion.
So who were the key players in those first few decades?
Well, after the infamous economic downturn, the Panic of 1837, for instance, control of the company was acquired by a man named Moses Taylor.
Moses Taylor.
Yeah, he was this really astute New York merchant, dealt mostly in sugar and coffee. And he guided the bank through all the volatility of the mid-19th century. But crucially, he had the foresight to invest heavily in U.S. government bonds during the Civil War.
Which would have stabilized the bank, right? While others were failing.
Exactly. It allowed it to emerge stronger when other institutions went under.
So that kind of shrewd, opportunistic leadership really set the stage. Then, as we move toward the turn of the century, the bank starts to hit a sort of critical mass.
It really does. Under the leadership of James Stillman, who took over after 1891, the bank cemented its domestic dominance. Stillman was, famous for his connections to major industrial figures like the Rockefellers.
Yeah.
And by combining this aggressive lending with very robust capitalization, the bank officially became the largest bank in the entire U.S. by 1895.
Wow, so it wasn't just a merchant bank anymore. It was a national financial pillar.
Absolutely. But, as you pointed out, that domestic size just wasn't enough for their ambition. The bank quickly became a pioneer in global reach.
In 1914, it inaugurated the first overseas branch of a U.S. bank in Buenos Aires, Argentina.
Right. But what's often missed is that their international activity actually started even before that formal branch. The sources note that the bank had been sort of quietly active in supporting plantation economies, like the massive Cuban sugar industry, since the mid-19th century.
So they had this early hands-on global vision. They were embedding themselves in international trade flows.
That is absolutely key to understanding why they were so uniquely positioned to become a modern-day multinational financial giant. They didn't just follow trade, they enabled it.
And it's clear this massive global footprint was paired with this relentless internal drive for innovation, an image the bank really cultivated, right, as this modern, forward-thinking force.
They were true innovators, especially on the consumer side, really making banking accessible to the average American.
Like offering compound interest.
They were the first major U.S. bank to offer compound interest on savings, way back in 1921. Compound interest, which means you earn interest on your interest, sounds simple now.
But it was a powerful incentive for mass saving at the time.
A huge incentive. And they pushed the boundaries on lending, too.
The unsecured personal loans.
Just 7 years later, in 1928, they pioneered unsecured personal loans. This was a radical move. Before this, banks rarely lent money without some form of collateral.
So this action fundamentally shifted the relationship between banks and individual consumers.
It established the model that's the basis for most consumer credit today. Then, post-Depression, in 1936, they were among the first to widely offer customer checking accounts to the general public.
So these innovations were huge steps toward mass consumer banking, but what about the things that fundamentally changed how, money markets themselves work?
That brings us to 1961, when they launched the Negotiable Certificate of Deposit, or CD.
A negotiable CD.
The sources note this was the first new negotiable instrument introduced into the market since 1888. That's a staggering 73-year gap bridged by their innovation.
For the listener who might not be familiar with the term, why was the negotiable CD such a seismic shift?
Because before this, CDs weren't easily sold to another party. Banks relied mostly on these volatile demand deposits. The negotiable CD allowed a bank to issue a promise to pay a fixed amount on a certain date.
And that promise could be traded on the open market.
Exactly. This gave banks a stable, reliable way to raise very large amounts of money from corporate depositors and institutional investors. It fundamentally changed how money markets raised and moved liquidity.
So it was a crucial tool for an ambitious bank that wanted to grow quickly.
Absolutely essential. And they kept pushing the envelope into the credit card space, too.
Right, the everything card.
They did. In 1967, they introduced the Everything Card, which, interestingly enough, would later evolve into what we all know today as MasterCard.
So they weren't just participating in the financial system, they were defining its products.
Very much so. And then came the technology that really brought banking into the modern age. The ATM.
Under CEO Walter Wriston in the mid-70s.
Correct. The company, then formally renamed Citibank, launched the Citicard, pioneering the use of 24-hour ATMs. Think about that. 24-hour access to your cash. That was a truly revolutionary concept.
It changed banking from a 9-to-5 face-to-face transaction into something instantaneous and always on.
And this was the backdrop for the rise of John S. Reed, who took over as CEO in 1984. The next 14 years saw Citibank become not only the largest U.S. bank, but also the largest issuer of credit cards and charge cards globally, expanding its reach to over 90 countries.
So by the late 1990s, Citicorp was this consumer banking leviathan with deep global roots.
Absolutely.
Which brings us to the necessary counterparty in that massive 1998 deal, the Travelers Group.
Right. And this was not an ancient, regulated institution like Citicorp. This was a modern conglomerate forged by the sheer aggressive will of its CEO, Sandy Weill.
Weill was the quintessential dealmaker of the late 20th century. His empire building was, well, it was aggressive and it was rapid.
It started in 1986. He took commercial credit, a consumer finance subsidiary, private, And then he just went on a buying spree. He acquired Primerica Financial Services, which already owned the major brokerage firm Smith Barney.
And his core strategy was all about cross-selling.
Precisely.
Yeah.
The goal was to build a financial supermarket. He wanted to ensure that all the entities within the parent company marketed and sold each other's services.
So if you bought insurance, you should also buy a brokerage account. If you got a loan, you should buy life insurance.
You got it. Maximize the revenue extracted from every single customer relationship.
The consolidation really sped up in 1993 when he acquired the venerable but struggling Travelers Insurance.
A company that had taken huge losses from bad real estate investments and the devastating Hurricane Andrew.
And with that acquisition came the logo.
The distinctive Travelers red umbrella logo, which he immediately slapped across all his businesses. It was this powerful visual symbol of his rapidly growing empire. And the deal added crucial property, casualty, and life insurance underwriting capabilities to his machine.
Okay, so the final decisive piece of the puzzle, the one that made Travelers a true Wall Street player, came in 1997.
Yes. Travelers acquired Salomon Brothers, a major bond dealer and investment bank in the bulge bracket category, for a massive $9 billion.
$9 billion.
And that acquisition was a stroke of strategic genius. It was designed to complement, not just replicate. Salomon was focused heavily on institutional fixed income products and trading, a real powerhouse in the bond markets.
While Smith Barney was strong in equities and retail brokerage.
Exactly. So by merging them into Salomon Smith Barney, Weil created this unified full-service securities unit ready to compete globally. It completed all the necessary components for the massive, game-changing merger that would follow just a year later.
It truly set the stage for one of the most consequential mergers in modern financial history.
Now we arrive at the pivotal moment that created the financial firm we're analyzing today, the historic merger of Citicorp and Travelers. It was announced in April 1998.
And it officially formed Citigroup Inc., which was, at the time, the world's largest financial services organization by a pretty significant margin.
The scale was just immense. You're combining Citicorp's global consumer network and lending capabilities with Travelers' huge investment banking, brokerage, and insurance underwriting capacity.
But right away, the power structure was questioned.
Oh, it was immediately fraught with tension. The leadership setup was just so fragile. You had John S. Reed, the steady hand, the operations technocrat from Citicorp.
And then Sandy Weil, the aggressive, deal-driven empire builder from Travelers.
And they were named co-chairman and co-CEOs. Given their vastly different management styles, Reed focused on tech and systems, Weil on deals and cross-selling it. It raised immediate, profound questions about the long-term viability of that shared leadership.
Everyone expected a clash of titans.
And they got one.
As a side note, the new company kept the Citi brand name, but they adopted Travelers' highly recognizable red umbrella logo, right? They used it until 2007.
They did. But that brand drama, it really paled in comparison to the regulatory drama that defined the merger. As you mentioned, this merger was, under the existing law, well, it was essentially illegal.
Precisely. This was a direct, massive challenge to the remaining provisions of the Glass-Steagall Act.
Right. For the learner, Glass-Steagall was enacted back in the 1930s after the Great Depression, specifically to separate commercial banking, the boring deposit-taking loan-making business, from the riskier stuff like investment banking and insurance underwriting.
So merging a commercial bank holding company like Citicorp with an insurance underwriter like Travelers was just forbidden.
Expressly forbidden. So this wasn't an accidental violation. This was a deliberate, calculated, massive gamble by Weil and Reed on legislative change.
They went ahead with the merger knowing they were violating the spirit, if not the letter, of the law.
It was an incredible act of strategic defiance. They were operating on a regulatory clock, knowing that if the law wasn't changed, they would have between 2 and 5 years to divest any prohibited assets.
So they were essentially betting that their size and influence would force Congress's hand.
Absolutely. Weil publicly stated at the time that they had had enough discussions to believe this will not be a problem.
And in a stunning vindication of that aggressive strategy, the gamble paid off.
It did. In November 1999, the Gramm-Leach-Bliley Act was passed, and it specifically repealed the relevant sections of Glass-Steagall,
opening the door for these massive financial services conglomerates.
For the first time since the 1930s, they could offer commercial banking, investment banking, and insurance all under one giant roof. Citigroup was positioned perfectly, having already done the merger, to immediately take advantage of this new deregulated environment. The timing was just breathtaking.
That massive deregulation must have just further fueled their appetite for expansion. In the immediate post-merger environment, Citi wasted no time.
No, in 2000, they acquired Associates First Capital Corporation for $31.1 billion in stock.
And this is where the dark side of that aggressive post-Glass-Steagall appetite immediately surfaced.
It really did. Associates First Capital had already been widely criticized for predatory lending practices. The sources show that Citi basically purchased a massive headache with this acquisition.
A company whose business model was built on exploiting vulnerable consumers.
Right. And the legal fallout was swift and costly. It immediately stained the newly formed conglomerate.
So how did that play out?
Citi eventually settled with the Federal Trade Commission, agreeing to pay a record $240 million in restitution to thousands of customers who were victims of these predatory practices.
And what were those practices? Things like flipping mortgages.
Exactly. Flipping mortgages, refinancing repeatedly over short periods to extract new, unnecessary fees, and packing them with optional expensive credit insurance that borrowers often didn't even know they were buying.
So this incident, early in Citi's life, demonstrated an alarming tolerance for risk and ethical corner-cutting in the pursuit of growth.
Very much so. Yet they continued to expand globally. They acquired the European American Bank in 2001 for $1.9 billion, and then Banamex in Mexico in August 2001 for a massive $12.5 billion.
That Banamex deal is fascinating. Why did they pay such a monumental sum for a Mexican bank at that time?
That massive price tag, the $12.5 billion, was a direct realization of that post-Glass-Steagall financial supermarket vision.
Because Banamex wasn't just a retail bank.
No, it was deeply embedded in the Mexican economy. It offered consumer banking, investment banking, and insurance. It gave Citi an immediate, unparalleled foothold in Latin America, a region critical for trade and corporate clients.
So Weil's goal was global scale, and Banamex was a ready-made platform for extending that cross-selling model into a high-growth market.
Exactly. But that initial ambitious vision of a frictionless financial supermarket, it eventually ran into some practical operational problems.
You leading to a major spinoff?
Yes. The core Travelers insurance underwriting business was spun off in 2002, just 4 years after the merger. And this decision was a powerful admission that the synergies they had bet on were just not outweighing the drawbacks.
What were the main reasons for that reversal?
The sources point to a few clear things. First, the insurance unit was just too volatile. Insurance earnings are seasonal. They're highly vulnerable to large disasters, like the huge losses after the September 11 attacks, which had just happened.
So it led to unpredictable financial results that acted as a drag on the stock price.
Right. The complexity didn't match the value. And furthermore, Citigroup found it extremely difficult to successfully sell insurance directly to its customers.
People were used to buying from brokers, not their bank teller.
Exactly. The promised cross-selling synergies just didn't materialize on the consumer side, which made the complexity and volatility of owning a massive insurance underwriter, well, pointless.
But if the synergies weren't there, doesn't that fundamentally undermine the entire justification Weil used to push for the repeal of Glass-Steagall?
That is the central critique of the mega-merger era.
Was the merger just about power and scale rather than actual efficiency?
It's a great question. While the merger absolutely forced regulatory change, a clear power play, the subsequent spin-off suggested that combining banking, securities, and insurance under one roof wasn't necessarily optimal for long-term profitability or stock performance.
So it was a realization that managing a truly frictionless financial supermarket was too complex, too volatile, and ultimately just not worth the structural drag.
I think that's right. The Travelers insurance business eventually merged with the St. Paul companies in 2004, forming the Travelers companies we know today.
But Citi controversially held on to that distinctive red umbrella logo for years, didn't they?
They did. They kept that iconic branding until February 2007, when they finally sold the logo back to the newly named Travelers companies and officially adopted the standardized corporate Citi brand.
So it took them almost a decade to fully disentangle the branding and structure of that original merger.
A very long time.
And here's where the narrative takes a dramatic and, frankly, a terrifying turn. Despite its pioneering past, its massive global reach, and the successful repeal of Glass-Steagall, Citigroup found itself catastrophically exposed as the subprime mortgage crisis began to accelerate in 2007.
And the failure here, it wasn't a sudden shock. It was a slow-motion, critical breakdown in risk management that had been ignored for years.
The primary source of trouble was their heavy, almost reckless exposure to complex, structured products.
Specifically, collateralized debt obligations, or CDOs, backed by troubled mortgages. For the learner, a CDO is basically a financial instrument created by pooling various types of debt, in this case, thousands of mortgages, and then selling slices of that pool to investors.
And the risk comes from the quality of the underlying mortgages.
Which in Citi's case had just evaporated.
And the failure here was less about bad luck and more about an internal culture that just believed they were smarter than the market.
Absolutely. It was pure arrogance modeled into mathematics. The company was using these elaborate risk models to assess their exposure, but the models had a fatal centralized flaw.
What was the flaw?
They were based on regional data and completely failed to include the possibility of a national housing downturn.
So they just didn't think it could happen everywhere at once?
The models effectively dismissed the probability of a nationwide collapse as incredibly remote, less than 1/100%. They genuinely believed diversification protected them from systemic risk.
That is a stunning, willful blindness, and it clearly infected the highest levels of leadership.
Oh, absolutely. Two names frequently cited as being instrumental in pushing the company toward this high-risk strategy involving mortgage-backed securities, and CDOs were board member Robert Rubin and the CEO Charles Prince.
Rubin, a former U.S. Treasury Secretary, was known for his influence. And Prince, the CEO, he became the face of the hubris.
There's that key moment of corporate overconfidence, summarized by Prince's infamous quote just before the crisis truly erupted in 2007. When he was asked why Citi was still involved in these risky markets, he said, Citigroup was still dancing.
The music had stopped for many, but they were determined to keep the party going because the profit margins were just so high.
Exactly. But while the executives were still dancing, someone inside the building was watching the band pack up their equipment and was ringing the fire alarm.
Richard M. Bowen III, the chief underwriter for Citigroup's consumer lending group, who became a critical internal whistleblower.
His actions were truly extraordinary, and they demonstrate the power of internal governance, or I should say, the failure of it.
So starting in June 2006, Bowen began sending weekly reports and memoranda to the board of directors about the extreme, unacceptable risks being taken on by the mortgage operation,
which was buying and selling $90 billion of residential mortgages annually. His job was quality control, and the quality was just non-existent.
What specific numbers was he seeing that were so alarming?
When he first raised the alarm in 2006, 60% of the mortgages they were dealing with were defective. 60%.
And that number just kept rising.
It didn't stop. It eventually exceeded 80% by late 2007. And crucially, Bowen wasn't just noting paperwork errors. He was warning that many of these mortgages were not just defective, but the direct result of outright mortgage fraud.
He didn't just warn them about financial risk. He knew the legal and regulatory implications of hiding this from the market.
That's what makes his action so powerful. On November 3rd, 2007, he sent an email, a formal record, to the chairman Robert Rubin, the CFO, the head auditor, and the chief risk management officer, explicitly warning them.
Warning them about what specifically?
That concealing this information from shareholders violated the Sarbanes-Oxley Act, or SOX.
Let's pause quickly to define that for the listener. What were the SOX implications here?
Well, the Sarbanes-Oxley Act, passed after Enron and WorldCom, requires CEOs and CFOs to personally certify that their financial statements and internal controls are accurate and reliable.
So for CEO Charles Prince to sign these certifications while Bowen was sending weekly, documented warnings that 60 to 80% of the assets were defective.
It meant the bank was legally exposed to massive fraud charges and executive accountability. Bowen requested an outside investigation. It was ignored. He was subsequently stripped of his responsibilities.
Wow. Talk about a failure of senior management to heed a profound warning.
It's textbook.
The market started reacting even as these internal warnings were being dismissed. April 2007, Citi announces 17,000 job cuts. They continued to underestimate their risk, only to announce another massive cut of 5 to 10% of their workforce in early 2008.
And the deterioration was stunningly fast. It was irreversible. By November 2008, Citigroup was technically insolvent, despite having already received $25 billion in initial government TARP funds.
In just 2 years, the company's market cap plummeted from $244 billion down to a mere $20.5 billion.
Shares were trading well below $1 on the NYSE, an unthinkable collapse for one of America's largest, oldest banks.
And the final job toll was horrific. The sources indicate that staff cuts eventually totaled over 100,000 employees globally as the banks just scrambled to shed capacity and stem the bleeding.
Which led directly to the massive, historic government intervention in late November 2008.
A bailout package that was unprecedented in scale and complexity.
Right. The government provided an additional $20 billion in TARP funds, bringing the total cash injection to $45 billion. But the crucial defining element was the $306 billion guarantee. Analysts often call it ring fencing.
Let's delve into that ring fencing mechanism. It's what truly confirmed the too big to fail status.
Right.
How did that guarantee actually work?
The U.S. Treasury, the Fed, and the FDIC agreed to cover 90% of the losses on a portfolio of $335 billion of toxic assets that Citi held.
After Citi absorbed the first $29 billion in losses themselves.
Right. This was essentially the government writing a catastrophic insurance policy for the bank. The assets technically remained on Citi's balance sheet, but the risk of catastrophic loss was overwhelmingly transferred to the taxpayer.
Without that guarantee, the bank would have been instantly liquidated.
Instantly.
So why did the government feel the need to step in with such overwhelming force for Citigroup specifically, even more than for some other struggling institutions?
The justification provided by the former CEO, Vikram Pandit, it really highlights Citi's unique systemic risk. It extended far beyond the typical definition of a domestic commercial bank.
He argued that a failure of Citi would have triggered worldwide chaos and panic, right?
He did, because of the potential collapse of its Global Transaction Services, or TTS, division.
That's a strong claim. What exactly is TTS and why would its collapse cause global chaos?
TTS is Citi's backbone for moving money globally. It provides critical treasury services, foreign exchange, and trade solutions for massive multinational corporations, and critically, for major governments and central banks around the world.
So it's not about loans, it's about the plumbing of international finance.
Precisely. Pandit claimed that if Citigroup were allowed to unravel into bankruptcy, 100 governments around the world would be trying to figure out how to pay their employees.
That speaks to how deeply embedded Citi was and remains in the actual operating mechanics of global commerce and state finance. They were too central to the global payment system to fail.
Absolutely. But the government intervention came with serious strings attached, reflecting all the public and political outrage.
It was a temporary, partial nationalization.
Indeed. Executive salaries were capped, bonuses were restricted until 2010, and the government initially obtained a massive 36% stake in the common stock, giving it wide powers over banking operations and a seat at the table.
Despite the outrage over bonuses, with hundreds of millions paid out even after they got the initial TARP funds, the ultimate financial conclusion for the taxpayer was surprisingly positive.
It was a very unusual conclusion. By December 2010, Citi had repaid the aid in full, and it generated a significant net profit of $12 billion for U.S. taxpayers on the investment.
The sources note that this profit was aided by a special IRS tax exception.
It was. But financially, the government recouped its funds and then some. Regardless, the reputational damage and the imposition of that too big to fail label, that was permanent.
Yeah.
The immediate aftermath of the crisis forced Citigroup to undertake this drastic multi-year strategic overhaul. It was all designed to shed risk, complexity, and the vast array of non-core assets it had accumulated during its merger spree.
And this began with the creation of what was essentially an internal bad bank.
That was the formation of Citi Holdings in January 2009. Citigroup was formally split into two distinct operating units. Citicorp, which has the core profitable businesses,
And Citi Holding.
which was the dumping ground. It contained all the non-core assets intended for disposition and winding down, predominantly toxic North American mortgages and other consumer loan portfolios. The division initially represented about $156 billion of GAAP assets.
So the managers were tasked not with growth, but with the difficult, politically sensitive job of winding down these businesses responsibly. Did that slow, painful strategy of the bad bank ultimately work?
It took 7 years, but yes. Citi Holdings finally achieved its goal of breaking even in 2015.
Meaning it was no longer dragging down the firm's core profitability.
Right. And it was officially eliminated in April 2016. That date marked a key structural milestone in their de-risking and simplification strategy.
Beyond the bad assets, they also started dismantling parts of the merged giant, including the legendary Salomon Smith Barney brokerage unit.
Shedding Smith Barney was a huge move. The unit held, $1.562 trillion in client assets across nearly 10 million domestic accounts.
So what did they do with it?
In 2009, Citi merged it into a joint venture with Morgan Stanley Wealth Management. This was a phased exit. Citi initially got $2.7 billion and kept a 49% stake.
And then by 2013, they sold the remaining stake.
For a massive $13.5 billion, completing their exit from the high-net-worth retail brokerage business.
This era was also heavily defined by new regulation designed to prevent another crisis, specifically the Volcker Rule.
Right. The Volcker Rule, passed as part of Dodd-Frank, limits bank ownership in proprietary trading operations and hedge funds, which were deemed excessively risky.
So to comply, Citi had to spin off its hedge fund unit, Citi Capital Advisors.
Correct. This move created Napier Park Global Capital in 2013, effectively shedding another layer of complex proprietary risk from the bank's balance sheet.
So if the first decade of the 21st century was about growth and merger, the second and third have been about strategic contraction and retreat, particularly from mass consumer banking globally.
It's a complete, profound strategic pivot away from that original wild vision of being a global consumer supermarket. The first wave hit in October 2014 when Citi announced its exit from consumer banking in 11 markets, including established operations in Japan, Peru, and Hungary.
Then came the second and arguably more shocking wave.
Announced in April 2021, an exit from 13 more consumer markets, including major high-potential centers like Australia, China, India, and Vietnam.
That signals a complete philosophical shift. Citi is now concentrating on institutional clients in these regions.
Viewing mass consumer banking as just too complex, too low margin, and too regulated outside of their core hubs.
Those are enormous markets to leave. What kind of deals did those divestitures generate?
They were massive transactions, netting billions but also illustrating the depth of the retreat. For example, the consumer businesses in 4 Asian markets, Indonesia, Malaysia, Thailand, and Vietnam, were sold to UOB for about $4.9 billion in 2022.
And their Taiwan consumer business was acquired by DBS Bank for $706 million in 2023.
Right.
So what's left of the global consumer empire?
Citi is aiming to operate consumer banking only in a highly concentrated set of regions: the U.S., Canada, Europe, Hong Kong, Singapore, London, and the UAE. They're targeting high-net-worth customers in specific urban centers, not mass markets.
And crucially, they also announced plans to exit their massive Mexican consumer banking operation, Banamex, in January 2022, a major piece of the Weil acquisition era coming undone.
Exactly. And this period of dramatic downsizing has coincided with new leadership. Jane Fraser became CEO in March 2021, the first female CEO of a Big Four bank.
And she is overseeing a dramatic modernization and reorientation of the firm.
She has initiated what is internally known as Project Bora Bora, an aggressive, top-to-bottom corporate overhaul. The goal is simplification and aggressive streamlining,
which includes the announcement of 20,000 job cuts, or at least 10% of the entire workforce, planned for 2024.
The core message is that the structure is still too complex and needs to be radically simplified.
And the most fascinating part of this modernization is the shift in their technology strategy, which is a direct response to massive regulatory failures.
This is a direct linkage between compliance and corporate strategy. Citi has faced massive regulatory fines, including the staggering $400 million fine in 2020 over long-standing failures in risk management and technology.
And another $136 million fine specifically cited for persistent data issues.
So the new strategy is to cut their reliance on external IT contractors by 20 to 50% and instead hire 50,000 full-time technology employees internally.
Hiring 50,000 internal tech employees is a phenomenal commitment. Is this primarily a defensive move against regulators or a move toward gaining a competitive technological advantage?
It is fundamentally a defensive, compliance-driven move. It's aimed at improving risk management and data governance by bringing core technical expertise and control in-house.
Because regulators hammered them for not being able to track their own data reliably.
Exactly. That led to risk failures. By centralizing control over the technology, the actual plumbing of the bank, they're trying to prove to regulators that they can finally monitor, manage, and prevent compliance breaches and systemic failures.
It transforms technology from a cost center into a core component of systemic survival.
Very much so. We've also seen Citigroup taking very public positions on major social and political issues, which reflects the pressure faced by major corporations today.
2 recent examples really illustrate this.
In 2018, under then CEO Michael Corbat, Citi changed its credit card policies to restrict the sale of guns to individuals under 21. They also placed restrictions on certain firearm-related transactions for their business customers.
That was a response to public pressure for banks to take a stand on gun control.
And more recently, in December 2024, Citigroup, along with Bank of America, announced they were exiting the Net Zero Banking Alliance, or NZBA.
A global initiative focused on climate neutrality.
And this pivot was reportedly driven by political pressure in the U.S. against banks perceived as limiting fossil fuel investment.
The narrative of Citigroup is defined as much by its strategic moves as it is by the sheer, overwhelming volume and dollar amount of regulatory penalties, lawsuits, and fines that date back decades.
I mean, you have to use these figures to illustrate the immense continuous cost of repeated compliance failures.
The fallout from the subprime mortgage crisis alone generated billions in penalties, confirming the issues ran deep.
Starting in 2010, Citi settled several charges for $75 million. And they had to admit that its exposure to subprime mortgages was over $50 billion, not the $13 billion it had previously stated to investors.
That admission of lying to the market was a huge blow to investor trust and a warning shot.
A big one. There was also the issue of deliberately false certification of loan quality directly impacting government-insured programs.
Right. In February 2012, Citi paid $158.3 million to settle claims that its Citi mortgage unit had falsely certified the quality of loans so they would qualify for Federal Housing Administration insurance.
And this action was notably brought initially by a Citi mortgage employee, Sherry Hunt. So this wasn't just misleading investors. This was defrauding a government program designed to protect housing stability.
And Citi was one of the 5 largest mortgage servicers that participated in that multi-billion-dollar national mortgage settlement in 2012.
Yes, to provide relief to distressed homeowners. But the largest crisis-related fine, the one that truly stands out, came in 2014.
That was the staggering $7 billion settlement with the Department of Justice.
To resolve claims that Citi had misled investors about shoddy mortgage-backed securities in the lead-up to the crisis. Attorney General Eric Holder called the bank's misconduct egregious.
He said that the bank systematically expanded its market share and increased profits by knowingly assuring investors that these toxic financial products were sound, even as their own internal model showed the risk was catastrophic.
It just confirmed that the firm prioritized profit over truth.
And beyond the housing crisis, Citigroup was deeply entangled in the major corporate accounting scandals of the early 2000s, like Enron, WorldCom, and Global Crossing.
Oh, their investment banking arm was providing services and selling stock while these companies were collapsing under fraud. The involvement resulted in massive payouts that spanned years.
What were some of the numbers?
They paid a total of $3.66 billion to settle Enron claims. For WorldCom, they paid $2.65 billion pre-tax to settle lawsuits concerning their role in selling stocks and bonds for the company.
And they also paid $75 million to settle lawsuits related to Global Crossing for issuing exaggerated research reports and failing to disclose conflicts of interest.
Right. These fines really illustrate the pervasive role of bulge bracket banks in enabling large-scale corporate malfeasance.
And it wasn't just accounting fraud. The investment banking and trading side also saw major scandals linked to proprietary maneuvers.
Yeah, look at the 2004 proprietary government bond trading scandal. Citigroup was heavily criticized for disrupting the European bond market by rapidly selling 11 billion euros worth of bonds on the MTS trading platform.
Driving down the price and then buying them back cheaper, netting a large profit.
The mechanism was complex, but the intent was to manipulate the market for quick gain. It highlights the immense conflict of interest that existed when a bank could both trade for itself and service clients.
And more recently, they engaged in a prohibited practice called spoofing.
In 2017, they were fined $25 million by the CFTC for order spoofing in U.S. Treasury futures markets. Spoofing is basically placing large fake orders for securities that are canceled before they execute.
It's done to trick other traders into thinking supplier demand is about to change.
Right. It moves the market price, allowing the spoofer to execute a real trade at a better price. Citi was found to have placed and canceled fake orders more than 2,500 times.
This pattern of misconduct extends deeply into consumer operations and basic compliance, suggesting a chronic failure to monitor internal processes, even in simple transactions.
The evidence of consumer compliance failures is extensive and costly. In 2015, they were fined $70 million and ordered to refund a staggering $700 million to customers.
For what?
For illegal marketing and sales of unnecessary add-on credit card products like credit monitoring and debt protection. This is a direct result of aggressive, illegal practices aimed at boosting revenue from their massive credit card base.
Practices that regulators deemed manipulative.
And the largest warning shot came with a 2020 fine from U.S. regulators that directly targeted internal controls.
That $400 million fine, that was the critical moment that defined Jane Fraser's subsequent strategy.
It was explicit. The fine was issued over long-standing failures to establish effective risk management and update technology, citing unsafe and unsound banking practices. Regulators noted Citi had failed to correct problems known for years.
Suggesting a deep systemic cultural issue that prioritized legacy systems and cost-cutting over robust controls.
Exactly. And money laundering has also been a persistent regulatory problem, especially involving their lucrative operations in Mexico and Latin America.
The problem stretches back to the 90s when a General Accounting Office report criticized Citibank's handling of funds for Raul Salinas de Gortari, the brother of Mexico's former president.
Right. It noted the bank facilitated the transfer of millions of dollars through complex transactions and failed to adhere to its Know Your Customer policy. In 2017, they settled allegations that their Banamex USA unit was used by drug smugglers to move dark money.
And most recently, in June 2024, agents from the DEA publicly cited investigations into the Sinaloa cartel, stating that money launderers continually found ways to exploit Citibank's lax controls.
The issue isn't just that it happened once. It's the persistent, decade-after-decade nature of the failure.
And finally, one of the most surprising and frankly shocking failures involved outright discrimination against consumers based on their ethnicity.
That happened in 2023. The Consumer Financial Protection Bureau ordered Citigroup to pay $24.5 million in fines and $1.4 million in restitution to Armenian Americans.
The CFPB alleged that Citi employees had used the presence of the surnames ending in Sainin or Yan, which are common in Armenian surnames, as an indicator for enhanced screening processes for credit card applications.
That level of failure in internal control and ethics, that they were using ethnic indicators to flag people, is just astonishing for a systemically important bank in the 21st century.
It speaks volumes about the lack of oversight.
The CFPB noted that employees deliberately avoided mentioning this discriminatory screening method in emails, suggesting management knew it was illegal and attempted to conceal it. This wasn't a technological glitch. It was a profound ethical and control failure.
That cost the bank millions and severely damaged its reputation.
Absolutely. And throughout this whole history, of course, there's the political context, the lobbying power of such a massive firm. Between 1998 and 2014, Citigroup spent nearly $100 million lobbying the federal government
to influence the very regulations they were struggling to comply with.
And their political contributions have historically been highly balanced, contributing 49% to Democrats and 51% to Republicans. This political dexterity ensures access and influence across the entire political spectrum, regardless of which party is in control.
An ability to navigate the political landscape that is absolutely essential for a company that constantly finds itself staring down regulatory investigations. So looking back at this 200-year timeline, the central narrative of Citigroup is truly defined by extremes.
It really is. They started as radical innovators, pioneering everything from consumer loans to ATMs and the negotiable CD.
And this innovation fueled massive, unprecedented growth through mergers, culminating in that 1998 Citicorp Travelers mega deal that successfully challenged and dismantled Glass-Steagall.
But that success was immediately overshadowed by an existential crisis, fueled by massive, poorly managed exposure to subprime mortgages, ignored internal warnings from people like Richard Bowen, and a catastrophic breakdown in controls.
Which required the U.S. government to step in with the largest bailout package of any U.S. bank, including that infamous $306 billion ring-fencing guarantee, cementing its status as the epitome of too big to fail.
Right. And the result has been a painful decade-plus of continuous strategic contraction. They shed the non-core assets via Citi Holdings. They got rid of huge businesses like Smith Barney.
And they dramatically pulled back from mass consumer banking across Asia, Europe, and Latin America. They are actively trying to become a smaller, more focused, and crucially, a less complex entity.
The key takeaway for you, the learner, is this. Despite shedding hundreds of thousands of staff and billions in consumer businesses, Citi remains one of the world's most powerful financial institutions.
And the firm today is intensely focused on the institutional clients group and global wealth management,
actively attempting to shed the systemic complexity and retail risk that nearly destroyed it in 2008 and has plagued its regulatory record ever since.
Which brings us to our final provocative thought. The source material highlights that the persistent, massive regulatory fines, specifically for the failure to establish effective risk management and data governance, have resulted in Jane Fraser's current plan to transition from external IT contractors to hiring 50,000 full-time technology employees.
So given the bank's history of catastrophic internal control failures, what does this massive internal shift say about the future of risk and compliance in too-big-to-fail banking?
It signals a profound shift. This is not just a technology upgrade. It's an attempt to centralize and internalize control over the very data and systems that failed regulators in 2008 and again in 2020.
So the question is, will making technology governance a core internal function finally allow Citi to move past the continuous cycle of massive fines and regulatory failure that has defined the last 2 decades? And how will this huge commitment to internal tech staff impact their core structure and performance moving forward in an industry that relies on agility?
That transition from a financial conglomerate to a financial technology governance company is the question that will define the next chapter for Citi and for every other bank deemed too big to fail.